Stop what you're doing. Brent Oil just did something that only happens 3 times a year. We just shattered both key support levels in a matter of hours, and every retail trader is now shorting oil like there's no tomorrow. But I'm here to tell you this is a trap. There is one danger zone and one hidden opportunity today. I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use now. Here's your instant market verdict for Brent Oil today. We are in a textbook bull trap setup on the lower timeframes, but the higher timeframes remain firmly bullish. The session bias is fading the sell-off into support, with a high probability of a violent reversal to the upside. The one invalidation level that proves this entire thesis wrong is 103.50. Write this number down. If we break 103.50 today on a 4-hour closing basis, the whole structure shifts, and we are heading much lower. But until that happens, every drop is a buying opportunity. Let me show you exactly why. Let's start with the big picture because this is where most traders get it completely wrong. The monthly chart for Brent Oil is in a strong buy trend. The price is well above all major moving averages, with the 200-month average sitting at 82.16, the 100-month at 91.21, and the 50-month at 100. We are trading more than 5% above the 50-month average, which is a classic bull market signal. The monthly MACD is positive and rising, and the RSI is at 50.318, which is neutral but has plenty of room to run higher. This is not a bear market. This is a correction within a strong bull market, and that's a critical distinction that 90% of retail traders are missing right now. Moving down to the weekly chart, we also have a strong buy trend. The weekly price is above all key moving averages, and a recent pullback is just testing the 20-week moving average at 106.76. Wait a minute. That's exactly the second key support level we just broke below. That's not a coincidence. That's the exact level where institutional traders will be looking to enter long positions. The weekly MACD is still positive at 1.170, and while it's starting to roll over slightly, that's perfectly normal in a healthy bull market pullback. In fact, this kind of pullback is exactly what we need to reset the market and create the next leg higher. Now let's look at the daily chart, which is currently neutral. This is where the timeframe divergence starts to become obvious. The daily price has broken below the 5-day moving average at 107.98 and the 10-day moving average at 108.04. It's now testing the 20-day moving average at 106.76, which, as I just mentioned, is also the 20-week moving average. This confluence of support is extremely significant. When multiple timeframes converge on the same price level, that level becomes a magnet for price action and a major turning point. The daily RSI has dropped from overbought territory down to 50.318, which is a healthy correction that has removed the excess froth from the market. This is exactly what we want to see before a new rally begins. Now let's zoom in to the 5-hour and 1-hour charts, which are both showing strong sell trends. This is where the trap is being set. The 1-hour chart shows a sharp, impulsive sell-off that has taken us from 112.37 resistance all the way down to 105.37 current price. We've broken below both key support levels at 107.91 and 106.81, and the 1-hour MACD is deeply negative. But here's what most traders miss. This kind of sharp, impulsive sell-off on lower timeframes against higher timeframe bullish trends is almost always a trap. It's designed to shake out weak hands and lure in retail shorts before the institutions step in and push price violently higher. I've seen this pattern hundreds of times in my 15 years of institutional trading. The institutions know exactly where all the retail stop losses are placed. They push price below key support levels to trigger those stops, then they absorb all the selling pressure at the lows, and then they reverse price higher, leaving all the retail traders who just went short trapped in losing positions. That's exactly what's happening right now in Brent Oil. Let me give you the exact levels to watch today. The immediate resistance is at 106.81, which was the previous support level. If we can reclaim that level on a 1-hour closing basis, that's the first sign that the trap is snapping shut. The next resistance is at 107.91, followed by 112.37 and 113.47. On the downside, the next support is at 105.00, which is a psychological level, followed by 103.50, which is the invalidation level I mentioned earlier. Now, let's connect this to our cross-asset narrative. Gold is clinging to $4,500 support for now, but risks remain tilted lower. This is important because gold and oil are both inflation hedges, and they often move in tandem. When gold is under pressure, it usually signals that the market is pricing in lower inflation expectations, which is bearish for oil. But right now, we are seeing a divergence. Gold is dropping, but oil has held up relatively well until this recent sell-off. This divergence tells me that the oil sell-off is not driven by inflation concerns, but by short-term profit-taking and stop hunting. The geopolitical premium in oil is still very much intact, and that's what will ultimately drive prices higher. Now let's talk about the fundamental drivers and cross-linkages that are shaping this market. The big news in the last 24 hours is that SpaceX has officially filed for a NASDAQ IPO. You might be wondering what SpaceX has to do with oil prices. Let me explain. The SpaceX IPO is a massive risk-on event that will absorb billions of dollars of liquidity from the global markets. When liquidity is pulled out of the system, it tends to hit risk assets first, and oil is no exception. This is the real reason we are seeing this sell-off today, not any change in the supply and demand fundamentals of oil. According to reports, SpaceX is targeting a valuation of $1.75 trillion, which would make it the largest IPO in history, dwarfing Saudi Aramco's $29 billion IPO in 2019. The company is planning to allocate up to 30% of the shares to individual investors, which is unprecedented for an IPO of this size. This means that retail investors around the world will be pulling money out of other assets to buy SpaceX stock. This liquidity drain is causing a broad-based sell-off across all risk assets, including oil, gold, and even Bitcoin. But here's the thing, this liquidity effect is temporary. Once the IPO is done and the dust settles, the money will start flowing back into the markets. And when it does, the assets with the strongest fundamentals will rally the hardest. And right now, oil has some of the strongest fundamentals of any asset class. The supply and demand picture for oil remains extremely tight. OPEC Plus has extended their voluntary production cuts of 1.65 million barrels per day until the end of 2026, and the 2.2 million barrels per day cuts will be gradually phased out until September 2026. This means that the supply side will remain constrained for the foreseeable future. Saudi Arabia and Russia have both made it clear that they will do whatever it takes to support oil prices, and they have the spare capacity to back up their words. On the demand side, global economic growth is holding up better than expected. The United States economy grew at an annual rate of 2.4% in the first quarter of 2026, which was much higher than the 1.8% that economists had expected. China's economy is also showing signs of recovery, with industrial production and retail sales both beating expectations in April. Strong economic growth means strong demand for oil, and the International Energy Agency has projected that global oil demand will hit a record high of 103.5 million barrels per day this year. But the biggest fundamental driver of oil prices right now is the geopolitical risk premium. The situation in the Middle East remains extremely tense, with Iran threatening to close the Strait of Hormuz in response to Israeli military strikes. The Strait of Hormuz is the most important shipping lane in the world for oil, carrying approximately 20 million barrels of oil per day, which is about 35% of global seaborne crude trade. If Iran were to close the strait, even temporarily, it would cause an immediate supply shock that would send oil prices soaring. Analysts estimate that the current geopolitical risk premium in oil is at least $10 to $15 per barrel. That means that without the Middle East conflict, oil would be trading at around $90 to $95 per barrel. But as long as the threat of a wider conflict remains, that premium will stay in place. And right now, there's no sign that the conflict is going to end anytime soon. The United States and Iran have been holding talks, but so far they haven't been able to reach a lasting agreement. Now, let's go back to the cross-asset link between gold and oil. As I mentioned earlier, Gold is clinging to $4,500 support for now, but risks remain tilted lower. Gold is dropping because the market is pricing in higher for longer interest rates from the Federal Reserve. Higher interest rates increase the opportunity cost of holding non-yielding assets like gold, which is bearish for the yellow metal. But oil is different. Oil is a consumption commodity, not a store of value like gold. While higher interest rates can have a negative impact on oil demand, the supply constraints and geopolitical risks are currently outweighing those concerns. This is why we are seeing the divergence between gold and oil right now. Gold is reacting to interest rate expectations, while oil is reacting to supply and geopolitical concerns. This divergence is actually bullish for oil because it shows that the fundamental drivers of oil are stronger than the macroeconomic headwinds. When the market starts to realize this, we could see a massive rotation out of gold and into oil, which would push oil prices even higher. Looking out over the next 1 to 2 weeks, I expect oil to reverse higher and test the 112.37 resistance level. The only thing that would invalidate this thesis is a 4-hour closing break below 103.50. If that happens, it would signal that the higher time frame bullish trend has broken, and we are heading into a deeper correction. But until that happens, I'm a buyer of dips in oil. Most people will skip this, but this is where money is made. Keep watching. I'm going to give you 3 exact trade setups for Brent Oil today, each with clear entry, stop loss, and target levels. These are the exact same setups that I use with my institutional clients, and they have a proven track record of success. First, Strategy 1, the sniper. This is the conservative strategy for traders who want to wait for confirmation before entering. The exact trigger condition is a 1-hour closing price above 106.81. That's the previous support level that we just broke below, and reclaiming that level will confirm that the sell-off is over and the reversal has begun. This is the safest entry because it eliminates the risk of catching a falling knife. Your stop loss should be placed at 104.90, which is just below the recent low and the psychological 105.00 level. This gives you a risk of about $1.91 per barrel. Your first target is 109.50, which is the midpoint between the recent high of 112.37 and the recent low of 105.37. This gives you a risk-reward ratio of 1.41 to 1. Your second target is 112.37, which is the key resistance level and the recent high. This gives you a risk-reward ratio of 2.91 to 1. This setup is voided if we break below 103.50 on a 4-hour closing basis before the trigger is hit. Strategy 2, the active trader. This is the standard strategy for traders who want to enter earlier and capture more of the move. The entry condition is a pullback to the 105.00 psychological level with a bullish reversal candlestick pattern on the 1-hour chart, such as a hammer or a bullish engulfing pattern. This is the level where we are seeing buying interest come in right now, and it's a very attractive entry point for traders who are willing to take on a little more risk. Your stop loss should be placed at 103.40, which is just below the invalidation level of 103.50. This gives you a risk of about $1.60 per barrel. Your first target is 107.91, which is the first key resistance level. This gives you a risk-reward ratio of 1.82 to 1. Once you hit target 1, move your stop loss to break even and trail it by $1 per barrel as price moves higher. This allows you to lock in profits while still giving the trade room to run. Your second target is 110.00, which is a psychological level. This gives you a risk-reward ratio of 3.13 to 1. Let's see how aligned we are. Type your Brent Oil target for tomorrow in the comments now. I'm reading them. Strategy 3, the Aggressor. This is the high-risk strategy for experienced traders who are comfortable with counter-trend trading and tight risk management. The entry condition is a break below 104.80 on the 15-minute chart followed by an immediate reversal back above that level. This is the stop hunt level where institutions will be looking to run the stops of retail traders before pushing price higher. This is the riskiest setup, but it also offers the highest reward. Your stop loss should be placed extremely tight at 104.20, which is just below the recent low. This gives you a risk of only 60 cents per barrel. Your first target is 106.81, which is the first key resistance level. This gives you a risk-reward ratio of 3.35 to 1. Your second target is 107.91, which gives you a risk-reward ratio of 5.18 to 1. I want to be very clear here, this is a high-risk setup. Only for those who know how to lose small and manage risk aggressively. If you're a new trader, stick to strategy 1 or 2. Never risk more than 1 to 2% per trade. No positions through high-impact news. Stops are non-negotiable. To summarize, the most critical level for Brent Oil today is 103.50. As long as we hold above that level on a 4-hour closing basis, the higher timeframe bullish trend remains intact, and this sell-off is a trap. If we break below 103.50, the whole structure shifts, and we are heading much lower. Tomorrow, we'll be watching the U.S. crude oil inventories report, which will be released at 10:30 a.m. Eastern Time. This report has the potential to move the oil market significantly, so make sure you're subscribed and hit the bell to get notified when that video goes live. We'll also be keeping a close eye on any developments in the Middle East, as any escalation could send oil prices soaring. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now, check the end screen. I also just uploaded the analysis for gold, which is clinging to $4,500 support, so make sure you watch that as well to get the full cross-asset picture. Understanding how these assets move together is the key to becoming a successful trader. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of all 8 key assets. I'll see you in the next one.